quarterly cash briefing for the UK, Eurozone, and North America. I'm Moni Lindsay, Managing Director in Treasury Strategies London office, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. We're pleased today to be joined by our panel, whose organizations are also sponsoring this event, Debbie Cunningham from Federated Investors, and Roger Merritt from Fitch Ratings. We will provide further background on our panelists before the panel discussion. Corporate liquidity has long been a core focus of our consulting work with both corporates and bank customers. Treasury Strategies began these cash briefings 12 quarters ago to better understand the relentless headlines at the time around cash hoarding. Was it really hoarding? What was driving the numbers? What was driving corporates? The headlines have changed, dominated currently by regulatory changes and bank fines. But our objectives with these sessions remain the same: to dig behind the numbers, observe what they are saying, talk to our clients, ask questions we all need to be asking ourselves. What are the implications of what we're seeing? What should we and our clients be thinking about? What actions should they be taking in light of the potential implications? As in the past, we will share with you the latest reports from the central banks on corporate deposit levels, look at the changing banking landscape, look at what our clients are saying and thinking, and discuss key game changers with our panelists and get their views on the implications for you and for the market. A quick preview of the next 45 minutes. Tony's going to share the latest reported cash levels. I will talk about changes in the banking landscape and headlines. Tony will facilitate the panel discussion, and then I'll wrap up. A word before we get started: our 45 minutes today gives no time for live Q&A. However, we want to take your questions, so please type them into the question box, bottom right-hand corner of your screen, either during or at the end of the webinar. We'll circulate the answers to all who have called in. So Tony, what are the latest reports from the central banks telling us?
Well, thank you, Moni, and hello, everyone. And let me wish everyone a happy 4th anniversary of the passage of the Dodd-Frank bill, which was yesterday. I don't know if you were out celebrating throughout the night. I wasn't. But let's go right into the corporate cash statistics. As you can see on slide 4, for the first time, we see a major break in the level of U.S. corporate cash. At 1.85 trillion U.S. dollars, we actually have a $90 billion quarter-over-quarter drop in U.S. corporate cash. That is the largest quarterly drop on record. Now, at Treasury Strategies, as we talk to our clients, our corporate clients, about their own cash positions, what we see is, companies just basically making their individual day-to-day business decisions. We're not quite sure that this is the beginning of a reversal, but we'll know more next quarter when we see next quarter statistics. There's been a lot of activity this year in cross-border mergers, and particularly mergers where U.S. companies are moving their headquarters overseas, and perhaps some of that activity is reflected in the drop of U.S. cash, particularly as you look in the other charts, where in the other jurisdictions that we're looking at on this page, corporate cash has increased. UK corporate cash was up just slightly, not at an all-time high, but Eurozone corporate cash in the bottom left corner actually crossed the 2 trillion euro mark for the very first time, and you see a fairly sharp spike upward there. So what we have in the UK and the Eurozone is cash increasing while U.S. corporate cash is decreasing. Now, in Japan, which is very aggressively stimulating its economy, we're seeing the continuation and perhaps acceleration of corporate cash on the balance sheets of companies in Japan, up to 243 trillion yen. But those numbers sound ominously big, 243 trillion. So what we're seeing is basically U.S. up, other jurisdictions down, and we'll be, in future cash briefings, we'll be looking at this to see whether the U.S. drop is a trend and continues. And of course, we continue to talk with our clients, both corporations and financial institutions, about what's going on there. On this next slide, you can see, going back now 14 years, corporate cash in most jurisdictions have more than doubled over the period. And the lines, for the UK, Eurozone, and US still seem to be pretty congruent, and we're beginning to see the Japanese line pick up after being flat until just about a couple of years ago. As you all know, one of the fascinating statistics that we've developed here at Treasury Strategies about 4 years ago, and we now see quoted and used fairly regularly in the news media and actually in some publications by central banks, is corporate cash expressed as a ratio of local GDP. You may recall last quarter in the U.S., corporate cash was at 12% of GDP. That $90 billion drop actually bumped this down to 11%. But by and large, for the last 2 or 3 years, these numbers have remained stable, with the U.S. at 11 or 12% of GDP, Eurozone in the low 20s, UK in the low 30s, and Japan at about 50%. So, we're seeing, particularly in the U.S., Eurozone, and UK, some relative correlation between GDP growth and levels of corporate cash. Again, as we talk to our corporate clients about the high level of corporate cash, one of the themes we hear is basically cash is a cushion, cash is a reserve. And we're going to be talking later on today about Basel III, regulatory uncertainty, Dodd-Frank, everything that is raising question marks on the part of corporate treasurers about their access to capital markets and about their access to liquidity from banks, from money funds, etc. And as a result, cash is building on the balance sheet, it seems to us, as a hedge against regulatory uncertainty. And we'll be exploring that, particularly when we get to our panel in a bit. Well, one of my favorite pages is looking at what's going on with the central banks and their reserve balances. And as you all know, several months ago, the U.S. Federal Reserve announced their tapering program, where they were going to taper the quantitative easing. And again, we point out the taper simply means slow down the rate of growth. It doesn't mean decrease. If you look carefully at the chart in the upper left-hand corner, you can see that the slope of the line has diminished a bit over the last several months, but still rising sharply, and is now in the range of about 2.6 trillion U.S. dollars on the balance sheet, held by banks on the balance sheet of the Federal Reserve, and that is up from $40 billion in late 2007. So we've gone from 40 billion to 2.6 trillion. So obviously you can understand what could be tremendous implications once the great unwinding begins. At the Bank of England, the reserve numbers have been relatively flat over the last couple of years, quite a contrast to the U.S. And at the ECB, we continue to see plunging levels of reserves at the European Central Bank. After having peaked at nearly 900 billion euro, we're down to just a bit above 200 billion euro, which is just an incredible 2-year drop. And in fact, it hasn't been this low since early 2009. So while we hear the European Central Bank talk about the need to stimulate and get the economy going, we still see a downward plunge in the level of reserves. On the next page, and we commented on at previous cash briefings, the Bank of Japan has announced a very accelerated stimulus program, and we're looking just in the last year of a tripling from 40 billion yen to, 40 trillion yen to 120 trillion yen, reserves that are being held at the Bank of Japan. Just a tremendous acceleration there. That doesn't quite, we saw on the earlier charts accelerations of corporate cash in Japan, but not nearly at the sharp rate as we're seeing bank reserves. Although we would expect, as we saw earlier in the recovery in the UK, the Eurozone, and the US, some spillover once banks have basically filled up at the Fed. Some of that money, or filled up at the central bank, some of that money spills over and actually gets into the economy and is on the balance sheet of individuals and corporations. The Swiss National Bank has been flat for about 2 years now in terms of level of bank reserves, and our sense there is that this is a managed monetary policy designed to basically lock in a fixed exchange rate. So we have a lot of things going on here, a lot of questions that we hear from our corporate treasurers about the uncertain environment. What happens when the central banks in the U.S. ease or unwind, or in the Eurozone, the central bank re-stimulates, huge capital flows, hundreds of billions or trillions of whatever currency you choose to think about, potentially moving and flowing, and ultimately, having the potential to create havoc or, at a minimum, uncertainty in the market. And it's this uncertainty that our corporate clients are very concerned about these days, and our financial institution clients are thinking through from the standpoint of how to offer the right set of products and services to their corporate clients, but at the same time stay compliant with Basel III, Dodd-Frank. You can go on and on and on that list. And our financial institution clients are certainly concerned about staying compliant with the laws in their various jurisdictions. And I'm going to turn it back to Moni to talk about what a significant challenge this particular item has become.
Yeah. Thanks, Tony. We thought it would be really interesting, given everything that's going on, to take a look at the current banking landscape from a couple perspectives. One is to look at who were the largest banks in 2008 and who are the largest banks in 2014. So just a couple of interesting facts. So if you look at 2008, the top 3 banks in 2008 are not in the top 5 in 2014. Only 2 banks remain in the top 5, and that's BNP Paribas and HSBC. The Chinese banks now account for 2 of the top 5 and 4 of the top 15, and they weren't there in 2008. But in 2014, they're very present. And then the very biggest banks did not get bigger. So if you look at the size of the largest 3 banks, or the largest 5 banks, they were actually slightly larger in 2008 than they are in 2014. So in 2008, we had RBS at 3.5 trillion and ICBC in 2014 at 3.2 trillion. But now when you drop down a little bit, and if you look at the banks with in excess of 2 trillion in assets and higher, in 2008 there were 7 banks, and in 2014 there are 12 banks. So some of the banks are getting larger. There's a lot going on beneath the surface. Some banks are selling off assets and others are growing rapidly. And all, as Tony has referenced, are really adjusting to the new post-crisis economics, the regulations, the politics. And the questions for you as corporate treasurers really are, what does the landscape look like for you and for your banks? And how are your banks changing? How are they changing in terms of their relationships, their solutions, and where are you going to be getting your capital? And if we can go to the next slide. So a fascinating topic is really what we're seeing in the headlines, and it's bank fines. And there are multiple headlines every day. We knew we wanted to discuss the topic of bank fines, but where to start? So the sheer volume of headlines on regulatory fines is dizzying. Trying to get your arms around total fines at any point in time is akin to herding cats. although we have come across some good attempts by the FT and others to do just that. In the end, we decided to share some examples of these headlines. And I'm not going to talk specifically about those, but again, I'm sure you've all seen many of these same headlines or something very comparable. But the trends, they show the trends. So the growth in fines, they're growing at exponential levels. So most notably from U.S. regulators, with the UK and Eurozone certainly playing no small part in those fines. A March 2014 FT article calculated that U.S. banks and their global rivals have paid out over $100 billion in U.S. legal settlements since the financial crisis, and over 50% of that $100 billion were paid out or levied in the last 12 months. So you can see the tremendous trend upward. And then this article was in March, so we've all seen the daily announcements since March that only add to that number. From the same article, the average size of fines has increased, so settlements of more than $1 billion are now commonplace. The average amount jumped from $22 million in 2008 to $638 million in 2013, and as you all know, we're seeing discussions of $7, $8, $9 billion, and then even today, there was talk of a $13 billion that's regulators in the bank can't agree on. So early on, the penalties were assessed mainly for money laundering and sanctions violations, but by 2012, this shifted to mortgage underwriting and foreclosure practices and repurchases of non-performing home loans from Fannie Mae, Freddie Mac. Along with settlements resolving allegations of defrauding investors or mortgage-backed securities. And now we're already seeing we're seeing a steady stream of LIBOR-related penalties from regulators on both sides of the pond. You can go to the next slide. So a good example of trend charts, we pulled these from a publication. This actually shows the fines from the FCA in the UK and its predecessor, the FSA. So the trends in the U.S. and the Eurozone regulatory fines would certainly look similar, but certainly from the U.S. be magnitudes larger. So what are the questions and implications for you? Questions are the regulators just getting retribution for the financial crisis, or are they cleaning up bad behavior? Most important, when do we reach the tipping point where banks simply become little more than compliance machines? When banks become so cautious that they can no longer be reliable financial partners. Regulations and fines are already changing how banks operate, what markets and segments they serve, and how they relate to their customers. We know as a result of Basel III, banks are getting very picky about deposits, the type of deposit, the amount, the tenor. And we're seeing some banks get out of certain businesses due to the regulatory scrutiny and the enormous potential liability on the banks. So for example, a number of banks have looked at their correspondent banking relationships. So not only are they being required to know their customers, but they're being required to know their customers' customers. So that's a tall order. And you as the customers need to understand how your banks are dealing with this. Are you in a vulnerable segment? Capital structure or geography. So how is this impacting you? Tony, I'm going to let you take over from here.
Thank you, Moni. It is kind of chilling as we speak with our bank clients. Essentially, the gray area is going away in terms of their relationships with customers. It's becoming more quickly very quickly a check the box kind of mentality, because the banks absolutely want to comply with the regulations. The regulations are written with less precision than we would all like, and as a result, that creates a lot of gray area and, frankly, a lot of questions for corporate treasurers about. As Moni pointed out, what will the bank's target segments be? What kind of business would they like? And what should I do as a corporate treasurer if I am not in a desired segment, or worse yet, if I am in a publicly recognized undesired segment? We're working with many of our corporate clients to help them know their banks better in this environment so that they can answer that question for themselves and perhaps even bring other banks into their program in order to be safe and to be assured access to liquidity. One of the major seismic shifts taking place and is now beginning to permeate out into the corporate marketplace from financial institutions is Basel III. And while banks have been working on Basel III and the liquidity coverage ratio and the net stable funding and all of those terms that we've all heard now for a couple of years, policies are starting to come out, and banks' behaviors are changing, and corporate treasurers are beginning to recognize that the impact here could really be profound. We put together a white paper. This is a short 4-page, fairly breezy kind of read on the changing rules of the game for corporate treasurers. And if you'd like a copy of that, I just want to point out here, click that link, which looks like it's fairly complicated, so maybe alternatively just send us an email and we'll be happy to send you a copy. The other thing I'd like to point out at this point before we go into our game changers and panel is that next week, on Wednesday, Treasury Strategies will be participating in a hearing at the U.S. House of Representatives Financial Services Committee on a 4-year retrospective of the impact of the Dodd-Frank rule. And we'll be preparing and delivering testimony next Wednesday morning. We would really love to hear from you about how Dodd-Frank has impacted you and how you think it has worked or has failed to work, the good, the bad, the ugly, whatever. Please send us an email with your thoughts, just Tony_Carfang@treasurystrategies.com or info@treasurystrategies.com as an alternative. Obviously, this will all be anonymous and confidential, but it will help us prepare our comments to the committee. Now, moving on to the potential game changers and setting the table for our panel, we have 5 issues that we'll be discussing today. Basel III implementation, which I just mentioned. Money fund regulation, as it turns out, next Wednesday is also the day that the U.S. Securities and Exchange Commission has scheduled a meeting. Money funds are on the agenda. They may or may not ask for a vote at that time, and the regulations may or may not pass, but we're going to be talking to folks who have a ringside seat there in just a couple of minutes. The rise of M&A activity, particularly with the inversion mergers and the attempts to restrict movement of corporate cash or to penalize movement of corporate cash, is now coming front and center. Over at the 9 o'clock spot, what happens when interest rates rise? And today we're going to take a view that looks a little further out on the yield curve. And what does this mean for investors, who are out more than a year or two on the yield curve to try to pick up a little bit of yield? And then finally, like a little bit of commentary about the new European Parliament. We have a new parliament that's elected. There's been some shift in the composition. The Eurosceptics seem to have won more seats than they typically do, and we're going to talk to our panel about how that may change European legislation and regulation. So with that, let me turn it back to you, Moni, to introduce our august panel this morning.
Yes, we're very excited to have them. So I'm going to introduce Debbie Cunningham as Executive Vice President, Senior Portfolio Manager, and Chief Investment Officer for Taxable Money Markets at Federated Investors, a leading investment management firm and pioneer in money market and fixed income funds. Roger Merritt is Managing Director at Fitch Ratings in New York, a leading global provider of ratings, commentary, and research. Roger is responsible globally for ratings on funds and asset managers. So, Tony, what questions do we have for our panel?
Well, let's begin with the upper right-hand corner of the game changers and Basel III implementation. And let me throw the first question out to Roger from Fitch Ratings. How do you see Basel III, changing the landscape for the corporate treasurers, the banks who provide services to corporate treasurers, and the money funds who provide financing sort of in the middle. Could you share a couple of your thoughts on that, Roger?
Sure, Tony, and thanks. Thanks for having us here today at the CAS briefing, and thanks to everyone who dialed in. Yeah, I think starting with Basel III as a game changer is highly appropriate, because I think it may represent one of the most significant changes on the horizon for corporate treasurers, for banks, and for money funds. Simply speaking, there's a lot of acronym that goes along with understanding Basel III. You've mentioned some of those things: the liquidity coverage ratio, the net stable funding ratio, the supplemental leverage ratio. There's a lot of complexity and nuance there, but I think the simple takeaway is that it means that banks are going to have to hold more capital and more liquidity, and that in turn has knock-on effects for both corporate treasurers and for money funds. So for corporate treasurers, it's clearly going to raise the cost of doing business with banks in important areas like liquidity and credit lines and derivatives. I think you'll see banks taking a much sharper look at the return of certain lines of business and either repricing it or perhaps electing to get out of certain businesses altogether. Some of the other regulatory pressures that we've talked about, I think, will also play a role in that. And we're already seeing a market impact in terms of banks' willingness to borrow at the shorter end of the curve, availability of repo, some of those things that I think are impacting the ability of money funds to invest, at least in the way they used to invest. And we're starting to see new capital instruments in the market that are specifically designed to address Basel III and be what I would call Basel III compliant.
And we're probably only seeing the tip of the iceberg of that at this point. Now Debbie, as the you're sort of right in the crosshairs of this. You're buying bank paper. You're expecting investors to invest in your money funds, whatever. So as capital flows in or out of banks as a result of Basel III, it probably impacts you immediately and directly.
It absolutely does, and it's kind of a double-edged sword. We love additional constraints, if you will, that are placed upon any issuer that we're using within our portfolios that allow our own internal analysts to consider them to be even higher from a creditworthiness perspective. On the other side, on the other side of the equation, when that starts to cut into their ability of the ability of those issuers to fund themselves, in the money market space, and we run into supply-demand types of concerns, that's when we get, sort of the negative side of the equation. And certainly there have been structures that, already, even though, a lot of this implementation is still years away, banks like to be, in compliance as soon as it's mentioned. And, one of the types of structures more recently that has evolved that directly addresses some of these concerns is what I'll call the partial non-call structure, where a bank will issue a short-term note of some sort. Maybe it's a CD, maybe it's commercial paper, maybe it is just a short-term note, with, let's call it a 6-month final maturity, and it's non-callable for the first 5 months. But then the bank, almost 95% plus of the time, will call it at that point when it is then callable. Otherwise, it slips into their 30-day and under liability bucket, which they don't want to occur because of the ramifications that has within, its own regulatory environment. So, that's a structure that, although it existed to some degree, not in the form that it does today and not for the reasons that it does today, but it has become quite popular.
Fascinating. So, Roger, is this just financial engineering and sort of moving the deck chairs around, or is this substantive improvement in the stability of the banking system?
Well, I think clearly banks, and I agree with Debbie. I think to the extent banks are more liquid and better capitalized, should be a net credit positive. So from that perspective, I think it does strengthen the banking system. And I think it also shows that there will always be intended and unintended consequences of financial regulation, and you need to appreciate that.
Moni, you're out and about in the London markets day in and day out. You must be hearing a lot of strong reaction to the Basel proposals.
Yeah, I think both from the banks and actually from the corporate side. So the corporates are certainly concerned about where they're going to place their deposits because they're already getting resistance from the banks on accepting some of the deposits and where they can place them if they're not really considered operating deposits. But yeah, and then the banks certainly trying to wrestle with what it is that they need to do, what they can be doing with their products and their solutions and their markets.
Excellent. Let's move on to money fund regulation. It looks like we're within a week of the SEC having a landmark sort of meeting to discuss the regulations. Debbie, could you bring us up to date on where you see things from your ringside seat?
Sure. There have been a lot of rumors in the marketplace over the course of the last 2 weeks. Part of those rumors culminated around the likelihood of a meeting by the SEC commissioners on July 23rd, which is next Wednesday. That, in fact, was announced on the SEC's website yesterday. So there's a 10 a.m. open meeting next Wednesday, July 23rd, of the SEC commissioners, and it will have to do with money fund regulation. Presumably at that point in time, they will be discussing and potentially voting upon the staff's recommendations. What we've heard, again from a rumor mill perspective, but with no confirmation, are that the staff recommendations are as follows. Number one, floating NAV plus gates and fees for institutional prime. Number two would be the gates and fees for retail prime. And number three, the exemption for government money market funds away from these requirements to be also extended to the municipal money fund side. So those are the three, sort of rumors that are expected in the SEC staff's recommendations on the rule change to the commissioners. Now, what we've heard from the commissioners themselves, very publicly in many instances, but also, in other forms, has been a huge division and continued dissension amongst them about what the appropriate path is. And, if you go away from the commissioners, certainly there's been, I would say, a lot of strategizing and public opinion placed since these rumors have started from all sorts, from academia, from, various of the Federal Reserve banks, from politicians, all, either for or against certain aspects of this rulemaking. So, it's hard to say whether, obviously the meeting will be held. The discussions will take place, and then we'll see if there's a vote. And if there is a vote that's taken, we'll then see, what the outcome of that vote is.
Roger, can you share your perspective on the big day?
Sure. Well, first off, if I could just touch on Basel III one more time. Or money fund regulation, just as a lead into that. I think the takeaway on both of these topics is that corporate treasurers are facing a real sea change in the environment in which they operate. And so I think two takeaways are one is proactive communication. I really think it's incumbent now more than ever to communicate up the chain to your CFO, to the board, so that they understand what these changes are and what the possible implications could be, so that they're not, they don't feel ultimately blindsided by, changes in how they and how the financial side of the business is forced to adapt. And then I think the second part of that is just, investment guidelines and investment policies. If you haven't looked at them recently, I think it's, Tony has certainly said, and I agree, that it's really best practice to look at your guidelines on a regular basis and to think about in a strategic way what, how they need to evolve as the markets evolve. So that being said, on the money fund regulation, yeah, I think it's, I think we're just waiting, like everyone else, to see what ultimately gets proposed, if anything, and then, clearly it's going to change I think the appetite for certain products in the market. We'll see new products coming to market, and I think it's not unreasonable to think that we'll need to revise our thinking about how we rate some of these products if they undergo a fundamental structural change and regulatory change.
Right. Now, one of the things that we've heard in the news over the last couple of days is the concern on the part of Commissioners Gallagher and Aguilar about the tax treatment of the daily transactions into and out of money market funds. And if I could just editorialize for a second, what we're hearing is that Treasury, U.S. Treasury, is in conversations with the SEC about how to meet Commissioner Gallagher and Commissioner Aguilar's concern about the tax treatment of money funds, and that would then pave the way for them to vote in favor of VNAV, fluctuating net asset value. Otherwise, they may not vote for it. And since Mary Jo White became SEC chairman, the money fund debate has really moved out in the open, has been above board, and and has happened in the sunshine. This seems to be more of a clandestine negotiation, and it may be, if Treasury whispers to the SEC, says, "Don't worry about it, vote for VNAV, we'll fix the taxes," that's kind of happening in the dark of night. And perhaps a better way forward would be for Treasury to put out a proposal on how it's going to change the Internal Revenue Service Code. And get comment on that before the commissioners actually vote on some pixie dust that's whispered in the middle of the night. With that, enough editorializing, let's move back to the facts and the rise of M&A activity. Roger, let me start with you on this one. We see a lot on merger inversions these days, as well as just plain M&A activity. From your perspective, again, in a rating agency, could you share some of your thoughts on this?
Sure. And I'm not a corporate ratings analyst, but I think clearly these transactions are driven at least in part by tax considerations, the penalties that are associated with repatriating overseas profits back to the U.S. So as these cash holdings build up overseas, there becomes pressure to put them to work, so to speak. So I think some of the M&A activity is clearly being driven by that. So I think from a ratings perspective, obviously you have two things that you need to consider. Well, generally speaking, liquidity on balance sheet is a ratings positive to the extent that it lowers the net debt levels and increases liquidity. So if it's being deployed, you have to take that into consideration. And then I think the other consideration is, to what degree are these transactions being motivated by financial engineering considerations versus a strong strategic underpinning or rationale. And to the extent that it's the former, that I think that's a potential concern.
Debbie, could you share your thoughts?
Yes, I think the M&A side of the equation is one that is dependent upon, sort of an improving economic situation. And, rising economies lift all tides, or rising tides lift all boats, or something like that, whatever the appropriate analogy is for that. And I think, that does cause additional risk or concern from our analysis standpoint. Yet I do believe that, historically, as part of our own analysis in looking at issuers, we address this propensity for firms to, engage in M&A activity or not. And although it increases that risk when the economy is actually improving, we still feel like, as part of our analysis, when we talk to management, when we get a better feel for, how their acquisitions in the past have been undertaken, what has been their mode of restructuring through that process, we get a pretty clear feel for the importance of maintaining, their high-quality credit characteristics, which are basically what we need to hear and be comfortable with in order for us to use that issuer regularly. So, although I think the possibility of that activity is sort of a negative in the overall time frame that we're approaching, which is an improving credit environment, I do feel, that we've gotten pretty good guidance in the past, and we'll continue to get such good guidance going forward from those issuers as we, sort of go down their due diligence path with them.
Thanks, Debbie. That's actually a great lead-in when you talk about an improving credit environment to what's going to happen when interest rates rise. And in particular, at Treasury Strategies, we see a lot of our corporate clients actually, extending their investments a little further out on the yield curve, beginning to reach for a little bit more yield. Is that playing with fire, Debbie?
I wouldn't call it playing with fire. I mean, I think, essentially, whether it's a fourth quarter 2014, which is sort of what's being thought about in the context of the UK, or a second quarter 2015, which is what's being contemplated in the U.S. market, or question mark as far as ECB goes, further out than that. There is always some rate outlook that helps drive your portfolio strategy. You certainly don't want to take large bets in the context of that changing rate outlook. But I think modifications as we go into that time period, which would include, maybe shortening your duration a little bit, maybe taking on a little bit more in floating rate issuers that would be responsive to that rising rate environment, might be more prudent and strategies that make sense in that rising rate environment. So, and then there's obviously using the expertise of money market fund managers that are out there and keeping more cash in money market funds with the expectation that that rising rate environment will impact them very directly, and then indirectly to the holders of those money funds also. So, I think there are certainly strategies that can be undertaken that, as long as you don't go to the extreme, are protective in a rising rate environment.
That sounds like sound advice. And Roger, that sounds consistent with what you were saying earlier about updating the investment policies and communicating up the chain of command.
Yeah, absolutely.
So moving on, the last game changer for our last couple of minutes here is the new EU Parliament. We had elections in May. The Parliament has been seated. The committees and the whole new structure is being worked out. Let me start with you, Roger. Do you see this impacting or changing the regulatory arc in Europe?
I think it remains to be seen, talking to the people we have on the ground in Europe who closely follow these issues. Clearly we've had a fairly significant set of elections with sort of a whole new cast of there's really a whole new cast of members in the European Parliament. So, how they approach the issue of regulation, I think, remains to be seen. the one we watched most closely, or had been watching most closely, was the EC's proposal on money market fund reform, and and there was a strong desire on the part of the former Parliament to try to come to a decision on that prior to the elections that took place in May. The timing, I think, proved to be too aggressive, and so it was left for this Parliament to pick up. So I think the open question is, do they embrace the proposal, and if so, what shaping or reshaping takes place under the new Parliament?
Debbie, could you share with us your take on the new Parliament?
Certainly. We've got, as was mentioned by Roger, a lot of changes from the Econ Committee to the MEPs themselves to whoever the lead, to the lead rapporteur. All of that, it leads to either scrapping what's already been proposed and starting anew, or at least reassessing, what is currently out there. The current presidency of the European Parliament is with Italy, and as sort of we understand, there doesn't seem to be a real propensity for the Italians to actually take money market fund regulation up within its 6-month presidency timeframe. So we're feeling that basically kicks the ball down the road, or kicks the can down the road into the 2015 timeframe, which we think is probably a good thing, because at that point there should be more clarity from a U.S. perspective as to what final rulemaking and decision making has brought forth here in the United States market. So certainly we don't want money market products across the world to look drastically different from one jurisdiction to another. So I think keeping the time frame into the 2015 time period, which looks to be our best guess at it at this point, is something that will lend itself to maybe a little bit more harmony and congruous type products as we go forward with whatever the rulemaking itself ends up being.
Well, as usual, great insights here, and a lot for all of us to think about. Before I pass this back to Moni, let me just remind you once again, send us an email with your thoughts on Dodd-Frank and the unintended consequences, or the good, the bad, and the ugly, and we will evaluate these and anonymously, obviously, incorporate them in the testimony that we're going to be delivering to the U.S. Congress next week. So with that, Moni, can you summarize? And
I'll wrap it up for us. So yeah, a lot going on, interesting topics. And a lot remains to be seen, certainly. But we do thank you for joining us in our 12th quarterly cash briefing, and a special thanks to our panelists, Debbie and Roger. We look out for our invitation for the briefing next quarter, and again, all the corporates on the line, be on the lookout for our next survey and take a few minutes to complete it. And as Tony said, please give us your thoughts on the Dodd-Frank before next Wednesday. Thank you, too, for your questions. We will answer and circulate to all who registered, and we'll also send you a copy of the report. We encourage you to look at our sponsors' websites and on